Hi, my name is Drew Moore. I've got Michael Reginelli, commercial risk advisor for us, and Brian Basting, our economist. And today we're going to digest the August USDA report. Michael, first question for you. What stood out most importantly?
I think the main market reaction was to the corn yield for 2021. The expectation was a 2 bushel per acre drop. That was the average guess. There's a 5 bushel per acre drop, lower than the lowest trade estimate out there. Obviously going to create some tightness for the new crop balance sheet. I think that's kind of the main thing that the market's paying attention to. Global stocks also tightened up quite a bit though.
Sure.
Corn and wheat in particular. Beans grew a bit, but both well below trade expectations. So from a global standpoint, it's creating a little bit of buying interest.
Sure. Brian, what stood out to you in wheat today?
Really aggressive world production cuts, Drew, in this report. USDA reduced Russia from 85 million tons to 72.5, and they reduced Canada from 31.5 to 24. So we've really reduced those exportable supplies amongst the competitors in the world. So it really puts a tremendous amount of emphasis now on the southern hemisphere crops in Australia and Argentina to make up for that shortfall. I would say that the Ukraine crop did increase from last month, however.
Okay. Good to know. Michael, as the balance sheet tightens up for corn specifically, but also soybeans as well, what does the demand structure look like moving forward? Is China going to take 25 to 30 million metric tons?
Right.
What do you see from a margin standpoint?
Yeah,
as well?
so we did see old crop corn and bean ending stocks increase a little bit, which is what Brian and his team have been forecasting here for a few weeks. So
Right.
that gives us a little more of a buffer, but obviously the cuts in production and yield tighten things up even more dramatically. So demand's going to be important along the curve. I think the major question is what's China going to do from a buying standpoint, particularly with the corn program, which has been lagging. The bean program seems to be picking up steam. Mm-hmm. We've seen USDA flashes the past 6 days of China coming in for US beans, which puts even more emphasis on the yield to perform, given the lower acreage base that we saw in the June 30th report. So bean balance sheet could be really tight, especially if we see an uptick in demand. Corn, it's hard to say right now. We need to see some export interest. The other thing driving basis and spreads is going to be farmer selling. We had a big rally into harvest last year. Maybe this is the impetus of that. But what the farmer tendency is going to be as far as selling actively corn and beans here this fall, putting bushels in commercial hands, is going to be a huge driver in tandem with demand to kind of frame up basis and spreads here this fall.
Sure. Brian, talking about producers, as we look forward into 2022, we see input costs up, anywhere from 50 to 75%, depending on your geography. What should the producer be looking at, and what does that do to your acreage intentions on the forward curve?
Yeah, you make a great point, Drew. The producer input costs this year are soaring compared to where they were a year ago. However, the price is now very firm for 2022. Looking out to, for example, to December 2022 corn,
Sure.
over $5 a bushel. November 2022 beans, over $12 a bushel. And also looking now at wheat prices for next summer, well over $7 a bushel. So defend your balance sheet. That's the message that we'd share with producers at this point. These are some opportunities, but as you point out, the market is going to squeeze those margins a bit. So really encourage producers to examine which risk management strategies they're most comfortable with and execute those strategies, because markets can change on a dime, as we've all seen in the past.
Absolutely. Thank you both for your time today.